think there's a few factors that feed into that, but the most important is just the lags on monetary policy, that if you look back to last year, remember the Fed only began to hike in March of 22. So when we were talking about recession risks in 23, that would have assumed a very rapid pass-through from the transmission of monetary policy into the real economy. In other words, it's premature. Monetary policy typically operates with a lag of about 2 years. So if you're going to see that recession, and it is an if statement, the base case is we don't get a recession, but if you were ever going to get the recession, it would be 24, not 23.
I think one of the things that has surprised a lot of people is the resilience of the US economy, right? And you know, yes, resilient, but not exactly firing on all cylinders. And to that point, we haven't really seen earnings estimates come up that month, certainly not commensurate to the amount of stock price gains in the US equity market. Is there a disconnect that could end badly?
Well, the first point there, I think, is on the macro. Actually, a little bit of weakness is your friend here. If the economy remains super strong, then that doesn't give the Fed the capacity to start cutting rates. So we need to see some degree of slowdown, which will provide disinflationary pressure, which will allow the Fed to truly pivot. So a little bit of weakness is actually quite helpful in this regard. To your point about the connection between the macro and the markets, we do tend to think that US equities right now are fairly valued, but there's limited upside at these valuations. The better opportunities might be in other markets.
I was looking at your call on India, that it's by far and away the most exciting growth story in EM. It's somewhat reflected on the Sensex. There's been some appetite. How do you play the Indian market?
I think right in India's case right now, you're looking at a strategic long-term growth story. So where we see many other economies beginning to slow for both secular and indeed cyclical reasons, in India's case, we see the start of a very significant upswing. We're looking at an economy here that could be growing at double-digit nominal GDP rates for the foreseeable future. And valuations, sure, you wouldn't argue that India is cheap right now, but I think there's still significant upside based on that growth story. How do you play that? I think there's an across-the-board story. It's not about one particular sector. And if you look at the small and mid-caps in particular, there's a huge opportunity to generate alpha in that market.
There have been a few issues over the years in investing in India, around the banks, for instance, clean-up required. Also, when it comes to elements of protectionism and certain policy from the government. What are the risks these days as you think about the next few years?
I think that simply points to the fact that you need to have expertise on the ground. It's a scale game. It's understanding not just the macro, but also that changing regulatory political environment. So you're quite right to say there are risks, as there are in any market right now. And I think for India's case, it's simply about being present and having significant track record on the ground there.
You were saying a second ago that there are better opportunities out there around the world other than the United States, and Japan is a stand-up performer last year and so far this year, up about 20% already year to date versus the S&P's 9%. Does it have more room to run, and why?
Absolutely. So Japan is the one major economy where inflation is not a problem, it's a solution. It's a solution to a 30-year-old problem.
We want inflation.
Absolutely. And so if you look at what the BOJ is doing, it's saying, look, let's take rates out of negative territory. There's an opportunity here to get back to a more normal monetary policy setting, but we're not in any way trying to choke off the inflationary pressures that we see right now. We embrace them in open arms. And what that means from an equity perspective is that firms suddenly have more pricing power. So when we look at developed markets right now, in our view, Japan is the most attractive both on the short term and indeed the long term. So there's significantly further to go, we think.